Today I want to walk through a question about how the real estate industry has been structured for decades. Why the buyer-agent commission model was rarely defended based on its actual merits. Before we begin, it's important to give full credit for the thinking behind this presentation. The ideas and framework come from Nick Offenkamp, a licensed real estate broker and founder of DIY Homebuyer Academy. In his essay, Why the Buyer-Agent Commission Model Was Never Defended on Merit, published on his Substack, Realtor Gone Rogue. For a long time, the system worked largely because it had always worked. The way agents were paid became an inherited structure, passed down, repeated, and accepted across the industry without being closely examined. But over time, every market structure eventually gets tested. And when that scrutiny finally arrives, it becomes easier to see the difference between something that exists because of momentum and something that exists because of true structural merit. That's where the industry finds itself today. I am Steve Colano, and this is a special confidential remarks. A compensation system that operated for decades with very little public examination is now being looked at more closely. And once the mechanics of a system become visible, an unavoidable question follows. Does the structure actually make sense? That's the journey we're going to explore. What's happening in real estate right now isn't unique. In fact, we've seen this pattern before. For decades, stock trading operated under a similar assumption. Commissions were simply the cost of doing business. Retail investors routinely paid $5 to $10 per trade, and very few people questioned it. Then in 2019, a single catalyst changed everything. Robinhood introduced zero commission trading. Suddenly, the alternative was visible. Within weeks, the largest brokerages in the world, Schwab, TD Ameritrade, E-Trade, abandoned their long-standing commission models. Not because the technology changed overnight, but because the justification for the old structure collapsed. Real estate is now entering a similar phase. Once an alternative or a transparency event exposes the mechanics of a system, longevity alone is no longer a defense. Right now, real estate looks a lot like a car with the check engine light on. The vehicle is still running. Transactions are still happening. Deals are still closing. But the dashboard is telling us something important. You have the Sitzer and Burnett lawsuits. You have regulatory pressure from the Department of Justice. You have increasingly negative consumer headlines. And you have a growing shift in consumer sentiment. Individually, each signal might look manageable, but collectively, they indicate that something under the hood deserves a closer inspection. A check engine light doesn't mean the car is broken today. It means ignoring the system any longer becomes risky. And that's exactly where the industry is right now. To understand the current structure, we have to go back to the original model. Before the 1980s, every agent in a real estate transaction worked for the seller. The seller hired the listing agent. That listing agent then cooperated with other agents, called subagents, who helped bring buyers to the property. But legally and financially, everyone was still working for the seller. The fiduciary duty flowed to the seller. The commission flowed from the seller. And the buyer was effectively unrepresented. Buyers certainly received help navigating the process, but they did not have a true advocate. Structurally, however, the math made sense. Loyalty and compensation flowed in the same direction. In the late 1980s and early 1990s, the industry corrected a major flaw. Buyers finally received their own representation. The modern buyer's agent was born. Fiduciary duty now flowed to the buyer, which was a meaningful improvement in consumer protection. But the compensation structure didn't evolve with it. Instead, buyer agents continued to be paid through cooperative compensation offered by the listing side. So while the fiduciary relationship shifted toward the buyer, the financial relationship still flowed from the seller. That created a paradox that quietly sat in the system for decades. The professional advocating for the buyer was being paid by the opposing side of the transaction. The model survived not because it was structurally elegant, but because it was convenient. If we compress 2.5 centuries of real estate into a single table, the progression becomes clear. In the pre-1980s era, buyers had no representative. Everyone worked for the seller, and the seller paid everyone. Transparency was relatively high. because the incentives were aligned. In the 1990s through 2024 period, buyer agents emerged, but the seller still paid through cooperative compensation. This created the famous free-to-you narrative that most consumers accepted without questioning. But beginning in 2024, the environment changes again. Buyers still have representation, but compensation is increasingly negotiated directly and disclosed upfront. Transparency is no longer optional, it's mandated. In other words, representation successfully evolved. Compensation simply lagged behind for 40 years. Now the system is catching up. For decades, buyers were told that their agent's services were free, but economically that was never true. The buyer-agent commission was always embedded inside the seller's expected transaction price. It sat below the surface of the deal, just like the submerged portion of an iceberg. Above the waterline, consumers saw only the purchase price. But underneath that number were several layers. The seller's net proceeds, the listing agent commission, and the buyer-agent commission. Because the cost wasn't itemized directly to the buyer, it rarely faced scrutiny. And when people believe something costs nothing, they rarely question its price. That invisibility is what allowed the model to persist for so long. Here's the core structural issue. A buyer's goal is simple: purchase the home for the lowest possible price. But the traditional commission model pays the buyer agent as a percentage of that final purchase price, which means mathematically, negotiating a lower price reduces the agent's compensation. Now, to be clear, most agents operate with professionalism and integrity, but the structure itself creates a subtle misalignment of incentives. The professional tasked with negotiating the best price for the buyer is financially rewarded when that price goes up. That's the loop shown on this slide, and it's the kind of structural tension that becomes difficult to defend once people start examining it closely. August 17th, 2024 becomes the forcing function. The new MLS rules fundamentally change how compensation is communicated. First, sellers are no longer required to offer buyer-broker compensation in the MLS. Second, offers of compensation cannot be advertised through the MLS itself. And third, buyers must now sign written agency agreements that clearly define compensation before touring homes. Taken together, these rules do something very powerful. They expose the price tag. Once compensation becomes visible, it stops being a background assumption and starts becoming a negotiable service. And transparency tends to accelerate structural change. One common reaction inside the industry is to say that not much has really changed. Some agents describe the new rules as simply adding a bit more paperwork. But from the consumer's perspective, something far more significant has happened. For the first time, buyers are being asked to sign documents that explicitly state what their agent will be paid. That visibility permanently shifts the conversation. Once consumers can see the price of a service, they begin evaluating it the same way they evaluate every other professional service, by asking what value they're receiving. And that expectation shift cannot be undone. 30 years ago, a 3% commission meant something very different than it does today. In the mid-1990s, agents controlled access to the MLS. They controlled property research, touring access, and market data. Buyers needed agents simply to see homes and understand what was available. Fast forward to today, and the consumer technology stack has completely changed that dynamic. Buyers can browse listings instantly, analyze school districts, schedule showings, and research markets from their phone. So the value proposition of the agent hasn't disappeared, but it has evolved. Agents are no longer gatekeepers of information. They are advisors navigating complexity. And that means compensation models must increasingly reflect advisory value rather than information access. As transparency increases, consumers are beginning to ask deeper questions about the architecture of the system itself. Why is compensation measured as a percentage of the purchase price? Why does that percentage automatically scale upward as home values rise? Why does compensation depend entirely on closing rather than the work performed? And why aren't services tiered based on the complexity of the search or the time required? These aren't accusations. They're structural stress tests, and right now, the industry doesn't yet have consistent answers to them. But those questions are exactly what drive innovation. If we built the buyer representation model from scratch today, it probably wouldn't look the way it does now. The legacy model bundles everything together. Services are packaged into a fixed percentage of the purchase price, paid only at closing. But modern service industries increasingly move toward unbundling. You could imagine tiered service levels based on complexity, retainers for advisory work, per-showing touring models, or performance incentives tied to negotiation outcomes. In other words, compensation could align directly with effort, expertise, and results. The goal wouldn't be to eliminate agents. It would be to design a system where the economics match the work. The system isn't collapsing overnight. Transactions are still happening, and agents are still serving clients every day. But the check engine light is on. And history shows that once structural questions reach this level of visibility, momentum alone is no longer enough to sustain the model. The responsible response isn't denial, it's inspection. For the builders of real estate's next era, agents, brokerages, and innovators alike, the opportunity now is to open the hood and design a compensation structure that truly aligns with representation. Because ultimately, momentum is not merit. And the systems that endure are the ones that can prove their value. This has been Confidential Remarks.